Well, hello, everyone. Welcome to part six, the final seminar of the six-part series, a masterclass with M&A game changer, Dino Lucarelli. My name is Zach Strobel. I work at NKU's Center for Innovation Entrepreneurship. We are partnering with Barnes Denning through our Entrepreneurship Through Acquisition program. And that program provides all the essential elements needed to prepare for, acquire, and grow a small business. Just a reminder, if you're going for the CPE credit, please make sure to fill out all of the poll questions that you will see pop up. Also, please check the chat box for information provided by Barnes Denning. And then if you have questions throughout the presentation, please feel free to put them in the chat and Dino will address them during the Q&A portion. With all that said, here's Dino Lucarelli.
Thanks, Zach. And thank you all for attending the final session. This will be regarding due diligence. The due diligence process is referred to a lot in a lot of different circles. And it depending on who uses the term, it could be very different or mean very different things. I would say that probably the most important misconception about due diligence is that due diligence is way beyond financial. Due diligence has lots of spider arms and legs into the operational side of the business. And so it's important in doing an acquisition to have a very broad approach to it. And with that, I'll ask Kat to put up our first slide. And I'd like to talk about, the next slide would be the first presentation. So from an overview perspective, you really need a team. And we talked about this in the first session, but you need a team of experts. And that would include legal, financial and tax, marketing and sales, information technology, insurance and risk management, and human resources and benefits. This is a sort of a standard list of competencies that you really should have as part of your team to do the due diligence. As I said earlier, the biggest misconception is people think of due diligence, oh, we're checking the numbers. Well, you can check all the numbers, but if you haven't checked the legal status of the company and whether they have outstanding lawsuits pending, if you haven't checked whether they have a poor safety record and they don't have good risk management history, they've had claims and significant claims and losses, those are qualitative and financial factors that extend way beyond a profit and loss statement or looking for recurring revenues, et cetera. So the first and most important thing in doing due diligence is to make sure that you have a proper team. Now, you might think, well, gosh, that's a pretty expensive process. If I want to buy a business and spend, let's just say $5 million on a business, what's it going to cost me to have each of these people do the work that is required? And I'll tell you how we do it. And this works. So we partner as a firm, Barnes Denning. We have a huge client base, and we routinely partner with outside specialists like this in a number of areas. So let's say a client asks us for, recently we had a client ask us, do you have a good immigration lawyer? We want to bring some people over from Europe and we need some immigration help. So we are routinely referring work to professional services firms like this. And they refer work back to us. So what we do in the M&A world is we routinely, I have these resource partners that I can reach out to and say, look, we're doing an acquisition. Would you be willing to come in and run the due diligence process from the human resources side? Look at the benefits programs, look at the compliance with ERISA, look at the 401k plan, and tell us if you see any holes, any problems, inconsistencies, has the reporting been done properly? And we get this done really at no cost to our clients. We play the quarterback, but we're able to we have these partners and they appreciate the fact that we would introduce them to new prospects. And so what you get is sort of a hungry service provider who gets an introduction into a potential new client. Now you think, well, maybe they're going to come in and tell you that things are wrong just to say things are wrong. But the simple truth is, we partner with professional people, and I've had some very important risks uncovered by the due diligence partners. The information technology people routinely come in and say, gosh, this platform is not protected. There's not proper backup. There's all kinds of problems with the firewall. And so it's a big value add to have that. And you cannot rely on your lawyer or your accountant to find all of these issues. This is, for most people, it's the most important decision they'll make in their financial career, is to buy a company. And without having spent, like I said, we can corral this group at no cost, because we're able to give them high quality introductions. So the first thing is the team. Secondly, as I said earlier, you get different people have different views of what due diligence is, but each due diligence process can have its own set of wrinkles. First, you want to understand who is the audience. So the audience for your due diligence, of course, it's you as the buyer, but it's also your banker. It's also your lawyer. It could be a separate investor. It could even be the management team that you're acquiring, that they want to know, because oftentimes owners know things that the rest of the team doesn't know. So you have to understand what your audience is and who they are, and then you want to ask your audience, what kinds of things would you like to see? Here's our standard protocol, and we'll go through that here in a few minutes. But are there any specific things you'd like to see? And so that helps you become a higher level service provider. And as an owner, you may have certain concerns. Maybe there's a customer concentration issue. So you want to dive deeper into that customer concentration issue. And you want to look at the prospects that they have on tap. And you want to look at their pipeline and backlog. You want to pay particular attention to that. But understanding what your audience, who your audience is and what they want matters. The timeline. So how long does it take? I would say to do a high quality due diligence process, just because you're working with different departments, you're working with different people in the organization usually. Sometimes you're working with their outside legal counsel or their outside risk manager or their outside HR consultants. Typically, we look at 60 days to get due diligence done. But, there might be circumstances where you need to do it faster and you need to do it quicker. Maybe the seller wants to sell really fast and the buyer really wants to get a deal done. But typically, we're looking at 60 days. And what's the end product? Now, there's a due diligence process, which I'll say is a broad stroke of analyzing not just the quantitative elements of the business, but the qualitative elements as well. And again, we'll talk about some of those qualitative elements. But there's also a very specialized report that's called the Quality of Earnings Report that is, I'll consider it to be
Hi, everyone. Not sure if you can hear me or not, but please hold tight. Looks like Dino is having some connection issues on his end. Let us try to get a hold of him, and we will solve this as soon as we possibly can. So please hold on for just a moment.
I think I'm back in.
Hey, Dino, looks like you just had some connection issues. Everyone
Can you hear me?
tight for just a minute, so feel free to pick up where you left off. I think you were gone for maybe about 60 seconds or so.
Can you hear me though?
We can, yes.
Okay.
I think everyone else
Sorry,
can.
folks.
Yes.
Okay.
Yes, they are responding. If they can.
So we're talking about this quality of earnings product. So as of the last 10 or 15 years, private equity firms have becoming very concerned, not just about the overall due diligence, but going down this alley called quality of earnings. Because of a lot of different things, changing accounting rules, differences between tax and accounting, inconsistencies in management reporting. Very often you can look at a set of financial statements and not quite understand what's the true expected cash flow from this company. We recently were looking at a deal and we were told that a special non-recurring item down in the after operating expense, there was a what they call it was down in the non-recurring items, but we were told that it was a special product line that they really wanted to account for separately from their other products. So they were doing a little bit of a funky accounting down there, but they said that's true income, and it was about $150,000 a year, and for the last 2 years. But what it really was, upon further analysis, we dove in. It was gains on liquidation of some of their equipment. So they were selling off equipment that they were a printer, and they were selling off old equipment and buying new, and they were reporting the gain down below the line, and it was distorting their earnings. So really, you had to subtract 150,000 from their annual earnings, and that took the company from 500,000 down to about 350,000 in repeatable recurring earnings, which, as you can imagine, it's a pretty substantial drop. So it really does matter from a quality of earnings perspective, and we'll talk about quality of earnings reports. Potential outcomes from due diligence. Well, it's interesting. We've spent a lot of time and we've talked about getting ready to buy or sell. We've talked about deal structures, talked about financing. We talked about the cost of capital and getting your expected return. Here we are at due diligence, and your most positive outcome of all is that what you've been told and what's been illustrated through the financial statements is in fact verifiable. I said is in fact verifiable and is accurate and can be relied upon. In that case, it's full speed ahead. However, not uncommon at all for us to find things in due diligence that cause us to say the price can't be what it is. Just like this particular example I gave you with the printer. We found something in due diligence that just simply shot holes in some of the arguments we were told, and that resulted in a price adjustment. And that's just the way it is. If we say that we're earning 500,000 a year and you can expect to earn 500,000 a year, and it turns out that that's not accurate, whether it was purposeful or just inadvertent, there's going to be a price adjustment. Or there could be a deal structure modification. You might say, well, gosh, I found out that, your plan for the next 3 years and the most recent year includes this brand new customer, but we're having problems with that customer. But that customer was a significant contributor to last year's earnings. So we may decide that we want to change the deal. We want to have an earnout for future earnings. So we're going to take some certain price. Maybe we'll take $1 million of the price on a $5 million transaction and create an earnout such that you have to perform at a level that's anticipated to get it. So it could result in a deal structure modification, or it could result in an escrow account. You find contingencies. You say, well, geez, we looked at everything, and in due diligence, we find out that you have 3 lawsuits pending for product liability. Well, that's a problem, obviously. We still think that the company's good. We think that, we've got legal opinion. We think we're going to prevail. But we're going to put $500,000 in escrow for contingencies. If we lose the lawsuit and our product lines are disparaged and we look, we lose some street cred in a court of public opinion, well, we need to be compensated for that. Or it could result in breakage. And actually, the deal earlier where I talked about the $500,000 and we found $150,000 flying ointment, that deal broke up. We ended up walking away from the deal. And the thing is, for sellers, it's really important for a seller to be cognizant of the fact that if representations turn out to be incorrect, it's sort of like, well, if you told me your earnings were this, turns out it's not correct, then what else do I not believe? You know, that ugly, you know, halo that it's a negative halo effect. So it's important to understand that the representations need to be clear. And if the buyer starts to find things that in due diligence, it can really sour a deal. Now, I've got the timeline here again. What I would say is, over in the objectives, we have timeline, but here, this is a little bit of a different timeline. One of the things that can happen is due diligence can spread out. You can end up having a 6, 8, 9 month due diligence timeline. We've seen that going on, and we got into significant discussions about human resources and people and org chart, and we had a lot of discussions around real estate. And we in the context of diligence, we found out that there were some real estate opportunities that would cause us to be able to operate at a better level as a buyer if we were to ferret out some different real estate options. So we did. And in the meantime, that timeline can be either good or bad. If you're the seller, chances are you want to close the deal as reasonably soon as possible, because you just don't want the buyer to lose interest, and you don't want something bad to happen in your business that mitigates the sale. If you're the buyer, you want to tend to go fairly quickly as well, because once you get outside the exclusivity period of a letter of intent, then the seller is free to take your deal and shop it. So it's important that you do it timely, but understand that in the timeline, you could end up going an extended period of time, and that while 60 days is fairly standard from an expected perspective, it's not uncommon to go further and deeper. And in this particular case, where we ended up going 6 months, 7 months later, the business took off. And what happened is we ended up adjusting the price. We agreed to it as the buyer, but the price went up by almost $1 million because the seller started having just some tremendous returns on their long-term investment in the company. And so the price went up. So it was a good thing for everybody, but it just as it can be good, it can also be very negative. Our advice is to try to get due diligence done quickly so that the financial partners can go ahead and make the commitments to fund the deal. Okay, next slide. Okay, now I'm not going to read to you guys, but I do want to go through some of this. So the due diligence checklist, and there's lots of different ones. Okay, but this is one that we found to be fairly comprehensive without going too deep. I mean, you can study something for, you know, month after month after month, but we feel like we've got a pretty good bead on the things we need to see. First of all, we need to see, you know, at least the last 3 years income statements, balance sheets, and cash flows, and that's internal on a GAAP basis. And oftentimes we don't have financials on a GAAP basis, so we have to convert them. Why is that important? Well, tax rules allow accelerated depreciation and other things that accounting rules don't. You could look at a company that bought a piece of equipment and wrote the whole thing off for $1 million, and they really had $1 million in earnings for the year, but it looks like they had zero income from a tax basis. So really important to understand what the true financial picture is, because that item would have been capitalized if you spent $1 million, and maybe you spread it out over 8 years. So maybe your depreciation was $130,000 that year instead of $1 million. And so maybe your income would have been $867,000 instead of net break even on your tax return. So we have to look at these things on a GAAP basis and not get hung up on the income tax basis. You want to look at plan versus actual results. If your company that you're buying has routinely overshot their estimates and underperformed relative to their plan, well, that gives you some belief that maybe the new estimates they put out there for future growth are high as well. So part of the due diligence is make sure that you look at the quality of their estimates and you factor that into your decision about what's next. There'll be financial reports that management has. You're going to want to break down sales by different types, et cetera. Backlog. We talked about backlog in several of these sessions. Really important to look at a backlog. If a customer or if a seller tells me they don't have a backlog, I can tell you that's going to make things a lot harder. It's going to put a lot more risk into the hands of the buyer. So important to be able to have and track your backlog. And then AR aging. Next slide. So from a projections perspective, we try to do quarterlies for each of the next 3 years. I think I've joked to this these sessions. I had a client that just, we were going to sell, and you're like, I cannot project what I'm going to do. And I said, you've been in business for 12 years. You've run this company for 12 years. If you can't project it, who can? And so, obviously we projected, we got the deal done. But it's important to be able to take it all the way through to a balance sheet as well. The more clarity of your projections that you can give, the easier it is to get bank financing. Think of it this way. You go to the bank and you have a full set of, you have a 5-year projection or a 3-year projection by quarter. You have income statements, balance sheets. You show the debt service. You show how much cash is going to be left after debt service. You run some bank ratios, quick ratios, inventory turn ratios, et cetera. You benchmark it. Now you go to the bank with that. And then the other guy walks in from another firm and he wants to buy a company, and he's got an Excel sheet with 3 years of projection by year. Who's going to get the attention from the banker? I can promise you it's going to be you, because you are giving them the equipment and the information and the data and the elements of earnings that they need to get an approval. At the end of the day, you want an approval. That's the whole point. I'm just going to move through this. You want to know that the business is predictable. You want to know that there's some stability and recurring earnings, or if not, that there's enough traction in the sales arena that as one client moves out, another one moves in. I was working with a customer who was thinking about selling his business, and we were talking about his erratic revenue stream. And it was interesting because he had inherited a business. He was a second generation, and he had been working in the business, and he was good at what he did, but we had some erratic earnings. And my view is, like, if you don't have recurring revenues, you have to be constantly replenishing revenues that are going to roll out with new ones. And you need a really robust sales engine to make sure that that's going on. But if I see revenues up and down, I have a hard time forecasting growth for that company. And if I can't forecast growth, that's going to result in a discount to the purchase price to the seller. Economic assumptions. We rely on some pretty cool data houses, that industry data, by industry, by sector. They talk about growth and consumer spending and housing start. We look at some of the key performance indicators, and we try to marry some of those up to our economic projections as well. So even at a micro level, where we're talking about small companies, if we see that the industry is shrinking, like the print industry is in many cases shrinking, if we can discern that the overall industry is shrinking, but we have a certain particular orientation of something we're doing that's emerging, we can fight that trend. But when you go to a financing partner or a capital partner, and you have data that doesn't jive or doesn't get reconciled back to the overall industry data that's available, it impairs your credibility, and it damages your opportunity to get the kind of financing you want. And when your financing gets cramped, that means you got to come up with more equity. Raising your equity investment raises your cost of capital, lowers the price you can pay. Okay, let's keep going. Capital structure. Who owns the company? So it's amazing how in due diligence we'll find out that, Aunt Sally owns 2%, and cousin Bill, he owns 4%, but I own 94%. I'm like, okay, but you have to have 100% agreement of all shareholders to sell the company. Have you talked to your aunt and to your cousin? And we find out that there could be all kinds of problems going on with the shareholders and what they've been promised. And this is particularly something to be worried about in the startup arena. A lot of people start up companies, and they will go ahead and do friends and family type capital raise. And this is a little bit off topic, but it's important. Friends and family, and they'll grant stock options or they'll grant equity to these friends and family in the first round of capital raising. And if those stock provisions are anti-dilutive, if they have what's called an anti-dilutive provision, meaning you can't sell more shares and reduce my ownership, then you can really put yourself in a trick bag as a startup company by having anti-dilutive provisions in your stockholder agreement. So that again requires, I mean, that's something that's pretty highly sophisticated. And if it's not a very simple capital structure, maybe you've got some preferred shares, you got A shares, B shares, maybe you have voting and non-voting shares, you really need a securities lawyer to look at those things and make sure that there are no flies in the ointment for sure. Okay, look at all debt instruments. Banks often have all kinds of provisions that are important for consideration in the terms of doing a deal. I mean, you could find that there's, in the bank agreement, you could find out that they have first priority liens, and there's certain things that they have to be resolved with the banks before you can do the deal. And off balance sheet liabilities. We're always concerned in due diligence about what don't we know. I mean, it's like, I always approach due diligence as if you give me everything that you can possibly give me, and I maybe know half of what I need to know about your company. So we're always looking for, like, what don't we know? And that could come in the form of, so let's say that you get inventory reports for the last 4 years, and they do a inventory every 6 months. You look at the reports, you look at the adjustments, and you go, okay, I get it. I see that they're writing off inventory. Well, you go, well, this is a pretty fast moving industry. And I'll give you an example. We were working with a company that was in the sold distributed circuits, fuses and circuits for for factory automation. And, like the technology components we use in our computers and our phones, what's the shelf life? 2 years, 3 years? Well, factory automation's the same way. So we looked at the inventory reports, they look fine. There's nothing that stuck out. But what we did then is we ran some specialized procedures to say, show us, we picked out like 50 items, and show us the sales reports, how many of these units you sold over the last 8 quarters, to see what velocity. And what we found is that about a third of the inventory hadn't moved in over a year. Stuff was obsolete. So, here we go, and we're looking at a deal for a couple of $1 million, and $1.5 million of its inventory. Deal went south. We killed the deal because the inventory, while the records looked good from a financial perspective, the quality of the inventory was such that it killed the deal. Other financial information. You need to look at federal and state tax returns just to make sure that the compliance is there. Also things like sales tax reports, et cetera, personal property taxes. You want to understand what the general accounting policies are. Nothing worse than finding out that people are making very broad assumptions about revenue accruals when those revenue accruals aren't there, or they're not taking reserves for bad debt, reserves for returns and allowances, all kinds of reserves, reserve for inventory obsolescence. You want to know that they're running the shop like a professional organization. And if they're not, then you're going to hit them with some additional expense. You're going to accrue some things, and you're going to reduce their earnings and thereby reduce the price generally. Okay, we'll keep going. Okay, you want to look at products. So hopefully if you're buying a company, you understand what product they make, but at least half the time our buyers don't. They're branching out into a new line, or they're a new buyer and this is their first time buying a company. They're not product experts. So you want to make sure that if you're not an expert in a particular product or technology or service, that you have someone on your team who can give you the sense that, this is state of the art. It's routine for us to hire experts to come in and look at, say, production methods that are being done in some of the manufacturing companies that we buy, to tell us, because I'm not a technology equipment guy, I can't tell you one computer-aided design machine from another. or one computer aided manufacturing equipment from another. I look at them, they look like important pieces of equipment, but unless you have an engineering expert or a shop floor expert who knows those things, you pretty much are putting yourself at risk. You want to understand what projected growth rates are and how do they jive with the industry? We talked about that. What's the market share? Who's the big boy and how are they growing? Are we impacted by the speed of technology change? And most every industry is these days. So what does that mean to us? Do we have new products coming out? Do we have enhancements coming out? Do we have product line extensions? What else could we be doing? Because when you're looking to buy a company, obviously, you're not buying the company to hold it as is. You're buying the company to grow it. You're buying the company to make it bigger and better and more profitable so you can overcome your cost of capital and have a high yield and start to build wealth. Okay, next. Okay. We always look for, either the top 10 or we go 15 customers for the past couple of years. And we want to see, are we maintaining the customers? Are we churning customers or are we keeping customers? If you're churning customers, that's a concern. You want to wonder, what's going on? Why aren't we keeping the customers we have? Strategic relationships are real important as well. Do we have any? What are they? Or what do they cost us? Do we want to keep them? You want to know if you have customer concentration. We've talked about this as one of the things in the first session. And then top 10 suppliers. Because depending on the circumstances, it wouldn't be out of the question to contact a couple of your top suppliers as the due diligence team and talk about the relationship and talk about why they're important and how they win and how you win and see where those relationships are. We've seen circumstances where the relationship is strained and the seller is paying a bigger price and the seller is not held in high regard by the vendors. So they get their service last and they get some extra charges put in. So, you want to know what you're getting into because the reputation of the seller transfers to you whether you like it or not. You have time to change it, but immediately walking in the door, you're going to be slapped with the same label that the seller is. And hopefully that's not bad. And if it's bad and we had this happen very recently where our client wanted to sign us up and we reached out to some people in the know to find out, is this a good company to work with? And the reputation was like, nobody in the industry wants to work with those guys. And that's why their sales are flat. So we ended up not being able to work with them. We couldn't help them sell their company because they had problems. Okay, keep going. Who are we competing with? How do we compete? How do we win? Why do we win? Real important to know that. You need to understand that. What's interesting about this is I was working with a printing company. I seem to get a lot of printing, HVAC, and landscaping, but manufacturers. I was working with a printing company, and we had 8 sales guys, and we had a pretty big region. Each sales guy. So I had a think tank session with them, and this was consulting work. It wasn't acquisition. But my question to them was, why do we win? Why do companies buy from us? I got like 7 different answers. Oh, we're the cheapest. Oh, we're the highest quality provider. Oh, we're the fastest. It's like I got all these answers, and these are 8 sales guys selling the same products and services to different regions. And clearly that company didn't have their identity nailed down as to who they were. Before you buy a company, you want to know who you're buying, why you're buying them, how they win, how they lose, and where your opportunities are, as well as where your challenges are. Okay. Strategy implementation, marketing, sales, distribution. What are our channels? Are the channels right? A lot of companies go through manufacturer rep to manufacturers. Well, do you want to go direct sales force? Do you want to go e-commerce? Do you want to change it up? Or you want to expand into it? One of the things that I would say is a fairly common finding with the deals we're doing these days is that a lot of the sellers have reached a point in their life where they're like, I know I could sell a lot more if I went e-commerce. I'm not ready for what the upheaval that'll bring to my business. I just don't think that that's something that we can bite off.
it's a tremendous opportunity for a buyer, somebody who's technology savvy to come in and say, let's go ahead and set up, an online e-commerce store. Let's get it going and let's double, triple sales. And particularly in this pandemic era where these, catalog places and warehouses and Amazon are just killing it. That's a really, really important find. When we find a company like that, we're like, let's pay them the going rate and get in and get moving. We were working with a very well-known company here in town. They were doing about $5 million in revenue, and they had a perishable product, and they did not have an online catalog. They were still taking orders over the phone and internet. So we piloted a catalog with 8 of their biggest selling items, and they literally declined to implement it. They were too scared because they didn't have the horsepower. They said, we're confident that if we go with these 8 products online, we're probably going to double our sales in the next 9 to 12 months. We don't have infrastructure to do it. That's a fantastic problem to have. Trust me, if you've got a company like that and you feel that that's true in your business, give us a call. We'll help you with all of it. That's just, but as a buyer, and you see that, that's a good upside opportunity, and you want to understand that. Somebody out in the parking lot blowing the horn. I hope you can't hear that. Major customers. So it's unfortunately not rare to see customer concentration 30, 40, 50% of total revenue. In that case, you're almost remiss as a buyer if you don't reach out to that customer and if you don't get the seller to grant you the opportunity to talk to them. I mean, if you're a major customer, let's say you are 30% of that particular company's revenue, and you find out at the last minute that a new owner walked in, you're not going to be happy about that. It's almost important for you as the new owner to start to build that relationship in advance and show transparency and clarity that if you come in, what can we do to enhance the relationship? And we want to be as lockstep with you as possible. So that's a positive step you should take. And if the seller doesn't want you to do it, you should be very concerned. If the seller has concentration and doesn't want you to speak to their major customers, it's a problem. Now, some of you might say, that's terrible. I don't agree. I teach this in university, and I was talking, and I had a very sophisticated guy who did a lot of work with P&G in his past, and now he was a money manager for some big family offices in town. And he completely rejected my notion that you want to be talking to your biggest customers if they're concentrated. And what was funny is one of the other students worked for Champion International. He raised his hand and said, we do acquisitions all the time. We definitely want to speak to the customers if there's customer concentration. We make that a mandatory thing. And if they don't give us access to them, we're not buying the company. So you're going to get different opinions. My opinion as the buyer, get access to the customers. Okay, let's keep moving. Okay. You want to know, how's my sales force working? Not dissimilar to the absence of e-commerce in a lot of companies, because the owners have reached a certain point in life where they just don't understand technology, or it's just too expensive to implement, or the downstream impact is too significant. We find a lot of companies saying, my sales force is not good. My sales team, they need energized. I don't think we have the right coverage. I don't think we have the right leadership. That's actually a good thing. That's actually a very positive thing. If you're buying a company that still looks pretty good and the financials are pretty good and they have a underperforming sales force, buy. I mean, we look at something like that and say, that's probably one of the most straightforward things to fix, is to hire some really strong people in the industry and pay them really well and put a new face on your company with that sales team. And if you've got a good product, you've got a good back office, you've got a good distribution model, you'll have some very quick positive results. So while we're looking for it, if it's really bad, let's say that the leadership of the sales team is three of the top 5 sales guys in the last 3 years have left in the last year. Well, that's a problem. So what you're going to do then is you're going to say, well, then you're not really selling me the company from 2019's results. You're selling me something that's less because of the damage that's been wreaked to the sales team. Now your top salespeople are out there selling for somebody else. I'm getting damaged goods. That would be very disconcerting to me. Okay. Keep going. Management personnel. So, when you look at the compliance with all the ERISA policies and the I-9s and all the applications, people tend to overlook HR. And while, I understand that it can be administratively burdensome, when we do a significant acquisition, we are typically looking at bringing in an HR professional to help us with the due diligence. It's just, there's too many specialized rules. And, we at Barnes Denick have some very good compliance people as well. So we can scrub a lot of the benefits plans, et cetera. But you really want to have an HR rep help you look at certain things and look at the compliance and the reporting, et cetera, as well as any compensation agreements, any contracts. Keep going. Okay. Incentive stock plans. Yeah. Just what else is going on in HR? Now, personnel turnover, this is a qualitative issue, but of course it damages your overall company. When you have high turnover, I've seen companies 50, 60% turnover a year. Oh, we hire these guys and they don't work out. And the cost of retraining and rehiring, as you all know, if you've been in business for any length of time, people problems are the biggest problems. They're the hardest problems to solve. But if you get them solved, then you're going to outperform your industry peers. And so we look to see if there's been big turnover, because if there's been big turnover in the last few years, we are inheriting that problem, and that's a cultural problem. And we need to know the depth and the severity of it. So it's just something that you're going to need to talk to people in the industry about it and find out what's going on, as well as the seller. Okay, let's keep going. Legal and related. It's weird. There are, I don't know how many counties in the state of Kentucky, for instance, but not all of those counties have their records online. So you could have, and this happened to us, so it's not like making this up. This company was down in, I don't know, we're about 50 miles east of Lexington. And we had a company that sold to farmers and sold to other agrarian companies. And we did a lien search and see if there were any lawsuits pending. We didn't find any. Well, sure enough, when we went to we went to buy the company and it hit the papers, a couple of them came out of the woodwork from some of these counties that had claims outstanding against the seller. So we had to dispatch with those, and we had to put a clause in the contract that the seller was responsible to settle up on those claims, and we put money in escrow for it. And so having good legal representation to do the due diligence, not just to do the deal, but to do the due diligence really matters. Environmental. We did a deal a couple of years ago. Everything was great until we looked at some environmental reports, and we found out that one of the federal agencies had brought a cause of action against our seller to remedy X, Y, and Z, but our seller hadn't remedied X, Y, and Z. And so it was about, I don't know, $75,000 cleanup that we had to have the seller do. And had we not found it, then think of this: you're the buyer. You buy a company. When you buy it, it's out of compliance with federal regulations, EPA regulations, which is what it was. And now, of course, it always happens. You're the new buyer. You walk in day 2 and walks the EPA guy, and you get fined for not cleaning up something that you didn't even know was existing as a problem. So this is where I really, really, really want to emphasize to people: when you're buying a business, get good legal representation. Don't have your estate planning guy do your acquisition. you need a lawyer to structure the deal, who knows how to structure a deal, and you need a lawyer who knows how to do legal due diligence. Really important. Okay, let's keep going. Okay. Summary material contracts. I'll talk about F. I was the contract CFO for a company, and we were looking to be sold, and we had a very large PE firm come in, and ultimately they offered $29 million for our company. In the due diligence process, now again, I had been hired earlier as the contract CFO, so I was there part-time. I had to provide the buyer with all of our material contracts. We had 95 contracts that we had signed from various divisions and operating arms of the company that were spread throughout the entire company. And many of those contracts had lapsed because we had not kept up with the insurance coverage or with the other requirements to provide financial statements. So we were missing out on opportunities to bid on work because our contracts were out of date and being rejected. So you want to know what those are, and you want to know that the company's complied with the provisions. How would you like to buy a company and find out that the second largest customer, which is what happened, had put you on a do not bid, do not call list at the end of the year because you hadn't met the year-end requirements for financial reporting, and you buy that company and not know. And then by the time you figure it out, you're like, wait a minute, I've missed 6 months of revenue to this customer, and it was an important customer. Okay, so I think that's the end of the due diligence checklist. Let's see if that's, nope, here we go, sorry. Information technology assessment. We don't ever buy a company, ever, without bringing in IT people to look at the back office and look at the cybersecurity, look at the technology, look at the platform, the architecture, and just look to see, are they using proper software? I was somehow I found myself as the chairperson of an animal welfare group here in town. That was a nonprofit, but it was a nice nonprofit. We had built an animal hospital, and we had big donors. Key Bank was a big donor. We had raised millions of dollars. Well, I went in and started looking at the software we were using, and we had a technology guy that was pirating software from his company, and so we were using software that was illegal. I mean, it was. And I'm going, wait a minute, this is not the kind of way you want to start out your company, is by understanding or finding out at the worst possible time that you're not using properly licensed software, or you don't have a good backup plan. You don't have good disaster recovery. You don't have good analysis to make sure that your machines are running properly. You don't have state-of-the-art equipment. Just obviously critical to have an IT expert look at your technology. And I would say the last 5 deals I've done, 2 or 3, we actually had to do some upgrades to bring the quality up, but a couple of them, they were fine. And our IT guys said, it's an outsourced group we use. They're like, they're fine. They're state of the art, their stuff's good. We don't see any reason for them to upgrade. But 2 or 3 of the 5, they did. And so now's the time to find out before you buy the company, and then you bear the cost. Okay, I think that's the end of the due diligence checklist. So that's in a very fast way what usually takes 60 days or 90 days or 120 days. And remember that when you're getting other people's money to help you buy a company, they want to see the results of this information. And so they're going to want to see that you vouch sales, and you looked at the customer concentration, you looked at the insurance policies, you looked at compliance with the rest of them. They're going to want to make sure that you've scrubbed the books and you've scrubbed the operating practices as well. So I want to move on now and talk quickly about a quality of earnings report, which is what I talked about as being a more specialized sort of approach. We've got 10 minutes. So the scope of procedures, I'll just let you read that, So what we're trying to understand in the quality of earnings report is, I want somebody who understands finance and understands accounting to go in and pull these financial statements apart and tell me what is really expected from an earnings perspective. When I buy this company, I don't want to hear about adjustments for this and inventory accruals and vacation accruals. I don't want to worry about the things that are accounting related adjustments that I don't quite understand. What I want to know is, how much am I going to see at the end of each quarter from a cash flow perspective after I pay all my taxes, after I pay all my vendors, after I pay for my, after I spend money for new capital? I want to know what's left. That's a quality of earnings report in a nutshell. You want to see what the recurring revenues are likely to be from the ongoing operations of the company. And you know, what I talk about in class is this: we as accountants bear some liability for all of the adjustments and the one-time things and the weird disclosures that, you know, if you give me, and I consider myself a fairly smart guy, but if you give me like a set of public company financial statements and say, come back and tell me, you know, what you think about the company, give me a week to study all the disclosures, all the information, the accounting policies, how they're applied, the consistencies, the lack of consistencies, the asterisks, the footnotes. It's very complex. So doing a quality of earnings analysis is to me, it's one step beyond due diligence. It's taking the highest precaution possible to understand the depth of the accounting adjustments and the accounting practices that are rendering the financial statements as they are. And so it's, when you do a quality of earnings report, generally you're going to find that there's some things that are specific to the company. Like one guy had a huge charity that he donated money to routinely, and it was charitable, which most companies wouldn't do. Some people have, you know, their kids on the payroll, which is not right. Some people are booking forward sales and it's not GAAP, it's not appropriate. And, you know, somebody gives them a purchase order, they book it as a sale, but they haven't shipped it. They're violating revenue recognition policies. There's all kinds of different things that can go wrong when you look at a set of financial statements without purifying them. I look at it like this: quality of earnings is cleansing the financial statements of all the noise that we'll say creative accountants try to put into them. So I see that there's several questions here, and I'm going to try to get to them. And we'll let you have a copy of this presentation so you can look at these quality of earnings steps. I'm not going to read them to you. It would take me another hour. But I'm looking at the questions. Let's see. Okay. Should I be concerned if the company adopted FRF financials instead of GAAP financials? I would say yes. I would be concerned. I would be concerned. I would just say that you want to know why, and you would want to know what differences exist in their particular implementation of FRF versus GAAP. So I would say that that's a fairly technical arena, and I would say yes, you should be concerned. And I would ask for clarity as to why and what drove that, and what would it look like on a GAAP basis. How do you do a complete search for pending lawsuits in so many counties? You can't, and you can't. We just you try to hire a law firm that hits out to the customers as well as the vendors that you do deal with, that you do business with, and you try to hit the top, 80% of your purchases and 80% of your interactions with customers, and try to hit those areas, but you can't. And if you fear that you have some of that, first of all, you're going to look historically. If there's been history of lawsuits coming from different, or claims coming from different areas of the state or country, chances are there's some stuff pending now. What you do is put some money in escrow to cover it, and maybe do an earnout as well. Let's see. Okay. Let's see. QE seems just as important as due diligence. What is the value proposition appropriate for a sub 2 million? I would say this way. We are literally doing a quality of earnings report right now for a company that's buying 3 product lines with total revenues of just at $2 million, and we're currently in the middle of it doing this quality of earnings analysis, I would say it's important. I would say for an acquisition of under $1 million, I don't know. I would put a lot of money in the escrow account, and trust the seller up to a point. But when you get into 2 million and above, this company that we're doing the due diligence and quality of earnings for, I mean, that's 2 million in revenue. So I think the overall enterprise value is going to be about $1 million. Now that is a high value, high return business. They got a huge internet business, but yeah, we're doing it. I would say if you're doing $1 million or more in enterprise value, it's worth it. I mean, a quality of earnings report might cost 20 grand, it might cost 30 grand, but it's good insurance. I mean, you want to know as much as you can know before once you plunk that money down. Unfortunately, and this isn't universal, but it's not rare either, a lot of sellers get their money and they're gone. I mean, they're off the reservation. They're in a different state, no forwarding address, and they got your money, and it just becomes problematic chasing them. So what other questions might we have? Well, I'll stay on for another minute or two. I want to thank everybody for bearing with me on these. I know the technology has been difficult, but I think we're all sort of inured to the fact that the technologies we use, Zoom and GoToMeeting, and these things are being taxed at the highest level. And some of us don't have the expertise doing it. Fortunately, my team does. But I would say this, if you've paid attention and you've attended these sessions, I hope that you've gained a level of appreciation for the complexity of the deals, but also I hope you've gained an understanding that, it's okay to ask questions. This is not simple. This is not like, I had a trucking company guy tell me, I thought this was gonna be like selling my house. I was like, hell no. You've got regulations, DOT regulations, you got safety regulations, you got OSHA, you've got equipment. No, it's not at all like selling your house. It's complicated. You need a team, and you need people that have done it before, because once your money's gone, and if the earnings aren't there, you're going to have a banker crawling, all over you. You're going to have other investors, and you put yourself in jeopardy. So hopefully what we've done is given you some basis to ask questions. Again, I talk about this in class. So I've got a bunch of really smart, the average age is probably 30 years old in the MBA program. I've got a bunch of really smart people, and they're all working at major companies throughout the city and the area. And what I tell them is, look, it's okay to ask the question. I mean, you can't be an expert in every area. You're an expert in your business, but you're not an expert in M&A. Don't be afraid to ask the question. If you don't ask the question and it turns out the answer is difficult or negative, and you didn't ask the question, you're accountable. So again, I'm always scared, even after doing this for 20 years, of what I don't know, even after a deal closes. You never know when it's going to jump out of the woodwork. But at least if we do our best, at least if we apply due professional care to our work, which we do, and we run it by several people, and we make sure that we look for secondary and tertiary validations of what we're seeing, that we can say, look, something may get by us, but it's not frequent, and fortunately not really significant, but we've had to kill deals because we found things. And just make sure that when you're doing this, you've got a crackerjack team and you're asking the right questions, and you should be fine. So I appreciate it. Thank you for the compliments. I think we are done, and I hope to hear from some of you in the future. If you want to talk about this, you want to get out and talk about doing a deal, you want to sell a company, if you just want advice, look, I don't turn on the billing the minute the phone rings. I've gone hour upon hour, meeting upon meeting with people, just talking about strategy, talking about opportunities, talking about options. I mean, that's not our game. I'm putting these on, and no one pays for these sessions. There's been a fair amount of prep work from our team. I think that there's goodwill that we want to share with our community. We have a great tax and audit and assurance business. We appreciate everybody who's a current client. And if you have any needs and want to talk further, obviously we're here, but you don't have to think that every time you call us, we're going to bill you. That's not our game. Barnes Dennett, we're a high quality firm. I'd like to think we do it right. I'd like to think that we give as much as we get from the community. And I just appreciate your attention. And if there's anything I can do, I'll do it. Thank you for the compliments, folks. Really appreciate it. Okay, I'm out.